Most people have diligently saved for decades as they're approaching retirement, and they get to a point where they might have hundreds of thousands or maybe even millions in a pre-tax retirement account of some kind, 401k, pre-tax traditional IRA, and they don't know, or at least maybe appreciate the magnitude of the partnership that they are building with the IRS as that account continues to grow with even just casual market performance. The tax obligation will continue to grow as well. And the IRS is so grateful to you for continuing to build up an asset that they get to tax. So when you're younger, you're working, you make contributions to these 401ks or the IRAs, and you get a tax break for making those contributions. It feels good. But IRS doesn't let you just keep those tax savings forever. They are deferred in the future, and you can only defer them for so long. Going forward, you're going to have to, at some point, have to take what's called a required minimum distribution. And what that means is that the IRS is going to tell you how much you have to take out at a minimum. That's so they can tax it. They want their tax revenue. So they are going to force you to take these required minimum distributions, or RMDs, and the age where they begin will depend on how old you are, but they're going to be either 73 to 75. Somewhere in there, you're going to be required to start taking money out of these pre-tax accounts, and then you're going to have to pay tax on them. So I always like to talk about fractions when I'm describing this. And if we take it all the way back to when you first learned about fractions, we have a numerator up top, and then we have a denominator on the bottom. So the numerator in this equation that helps the IRS figure out how much money you have to take out, the numerator is your account balance every December 31st. The denominator is your remaining life expectancy. So going back to what I was saying about just even pedestrian market performance, if we take, say, $1 million and we have a 5% rate of return. So now we're $1,050,000. Okay. But you have a slightly, so that's our numerator. And that means that you're now dividing by your remaining life expectancy, which, congrats, you're still alive, but now you have one fewer year in that life expectancy. It doesn't go down exactly by 1 year, but let's say for the sake of argument that it does. So say you're 65 and your remaining life expectancy is 20 years. Well, now 1 year later, you'd be divided by 19 years. So what happens when you divide a larger numerator that's gone up with market appreciation by a smaller denominator that's gone down with you've survived? Well, you're dividing a bigger number up top by a smaller number on the bottom. That means that the distributions grow over time. IRS is they're so happy that they're just going to tax you even more. They want your accounts to grow. But the formula is roughly designed to make sure that your accounts are liquidated by the time you die. There is something we can do about this. There is some good news. We have control. We don't have to wait until these RMDs kick in. We can choose to start paying taxes in advance, even though we don't have to. We can start to pay a little bit of the tax bill on the earlier side when it might make more sense for you than it does for the IRS, and kind of get out in front of these required minimum distributions. So it could help you pay hundreds of thousands of dollars less, potentially, depending on your situation. It could help you pay less in taxes over the rest of your life, but also could help you hang on to more of your Social Security benefit. And now, because of the way that retirement accounts are handed down from generation to generation through beneficiaries that are inheriting assets in a pre-tax account, they don't have the luxury of stretching, that's what they used to call it, stretching distributions out over their remaining life expectancy, most beneficiaries anymore. Now, for most beneficiaries that receive, grandpa's or mom's pre-tax IRA, they have to liquidate the account within 10 years. If you think about it, that's especially damning because the beneficiary is probably in peak earning years. If we just kind of do some rough math, we say mom or dad was life expectancy when they passed. That means that their kids are probably anywhere from 25 to 35 years younger than them. In their peak earning year. So they're already in their highest tax bracket. And now they have to start taking these distributions that are going to be taxable. And it's going to increase their income, maybe even, the marginal tax bracket that they pay taxes in on some of the distributions. So this can be thwarted a little bit by getting out in front of these RMDs, paying the taxes on the pre-tax accounts proactively, and moving those assets to Roth accounts so that you pay the tax at the best tax rate that's available to you. And if you haven't spent all of that money down by the time you pass away, the money you leave behind will be tax-free to your beneficiaries. So that's not the priority. That's always kind of a secondary goal. We want to make sure that the money is there for you first to take care of you and your needs. But if it is left over, wouldn't it be nice if it was passed as tax efficiently as possible to the people that you care about? So this is something I would love to help you with. And there are a lot of moving parts, and it's not something that can just be done once, probably. It's something that we would look at every single year and do detailed projections to make sure that you're not going to hand more money over to the IRS than you have to. So I'm happy to help you look out into the future a little bit and take a look at our crystal ball and do some great tax planning. That's a lot of fun for me. And I think that once you start to see the results, you might find that it's a lot of fun for you to